Welcome back to Business Training Media's Financial Freedom and Investing series. Today, we're tackling a burning question for many investors. Are rising costs eating away at your savings? Is your passive income struggling to keep up with inflation? You've heard real estate is a great inflation hedge, but what about accessible options like REITs? Let's dive into the truth about REITs as an inflation-proof income source in today's volatile economy. For those who are newer to the channel, let's quickly recap. REITs, or real estate investment trusts, are companies that own and operate income-producing real estate, from shopping malls and office buildings to apartment complexes and data centers. They offer individual investors a way to get exposure to the real estate market without the direct responsibilities of property ownership. A key characteristic of REITs is their requirement to distribute at least 90% of their taxable income as dividends, making them attractive for passive income streams and offering diversification within a portfolio. Now let's address the core of our topic, the idea that REITs can act as an inflation hedge. The logic is straightforward. As the cost of goods and services goes up, inflation, landlords can typically raise rents over time to reflect these increased costs. Furthermore, the underlying value of the real estate assets themselves can also appreciate in an inflationary environment. Historically, there has been a general correlation between inflation and REIT performance, leading many to believe they offer a safe haven during periods of rising prices. But here's where we get to the crucial nuance. Not all REITs are created equal when it comes to hedging against inflation. The ability of a REIT to pass on increased costs to tenants and benefit from rising property values varies significantly by sector. For example, industrial REITs, which own warehouses and logistics facilities crucial for e-commerce, tend to perform well in inflationary times due to strong demand and shorter lease terms that allow for more frequent rent adjustments. Similarly, residential REITs, particularly those focused on apartments with shorter lease durations, can adapt to rising costs more quickly. Self-storage REITs also often have pricing flexibility. Self-storage REITs possess significant pricing flexibility primarily due to the short-term nature of their lease agreements, typically month-to-month contracts. On the other hand, sectors like office REITs, which often have long-term leases, may struggle to increase rents rapidly enough to offset inflation, especially with the ongoing impact of remote work. Retail REITs can also face challenges if their tenants are struggling with increased operating costs and reduced consumer spending. Another critical factor to consider is interest rate sensitivity. REITs, as companies that frequently use debt to finance their property acquisitions and operations, can be negatively impacted by rising interest rates. Higher rates increase their borrowing costs, potentially squeezing their profitability. Additionally, as interest rates rise, other fixed income investments like bonds may become more attractive to investors seeking income, potentially leading to some capital outflow from REITs. This is a crucial piece of the puzzle often overlooked when solely focusing on the dividend aspect. So how do you invest in REITs for inflation resilience in this complex landscape? It starts with a sector deep dive. Focus your research on those sectors fundamentally positioned to benefit from inflation, like industrial, residential, and self-storage. Next, pay close attention to balance sheet strength. Look for REITs with lower leverage, less debt, as they are better equipped to weather rising interest rates. Understanding lease structures is also key. REITs with shorter average lease terms have greater flexibility to increase rents more quickly. Consider geographic focus as well, looking at REITs operating in markets with strong economic growth and limited supply. Finally, when analyzing REITs for inflation protection, look at key metrics like funds from operations, FFO, and adjusted FFO, AFFO, to gauge their cash flow generation, understand their net asset value, NAV, and compare the dividend yield within specific sectors to identify potential opportunities. Ready to navigate the REIT market with confidence and build a portfolio that can potentially weather inflationary pressures while providing consistent income? Do you want to learn the in-depth strategies for identifying resilient REITs and integrating them into a diversified portfolio designed for long-term success in any economic climate? You'll find all the links to our recommended investing strategies and asset classes courses, especially those focused on value investing and portfolio management, in the description below. Gain the knowledge and tools you need to make informed decisions about REIT investing in today's economy. Visit us online at businesstrainingmedia.com for even more online personal finance and investing courses, insightful articles, and valuable video guides. Thanks for watching, and here's to building a resilient income stream.